Imagine two drivers. Same age. Same car. Same clean driving record. Yet one pays $1,500 a year, while the other pays over $3,000. Why? Because most people don't understand what they're actually buying when they get car insurance. In the next 10 minutes, I'll break down car insurance in simple terms, show you the 3 biggest mistakes people make, and give you a checklist to review your current policy. By the end, you'll know exactly how to stop overpaying in 2025. Welcome. This channel is all about making insurance simple. Car insurance. Home insurance. Health insurance. No jargon. No sales pitch. Just clear explanations and visual comparisons to help you make smarter decisions. We focus on international markets, the US, Canada, Europe, Australia, and our goal is to help you save money without losing important coverage. If you want clear, honest breakdowns before you sign any policy, hit that subscribe button. Let's get started. First, let's cover what car insurance actually is. Think of it as a protection bundle with different layers. Here are the main components you need to know. Number 1, liability coverage. This covers damage you cause to other people or their property. It has 2 parts, bodily injury liability, which pays for injuries to other people, and property damage liability, which covers their car or fence or whatever you hit. In most places, this is legally required. And here's the key, if you cause a serious accident, your liability coverage is what protects you from being sued into bankruptcy. Number 2, collision coverage. This pays to fix your own car if you crash into something, another car, a tree, a guardrail, whatever. Collision is usually optional, but if your car is financed or leased, your lender will require it. Number 3, comprehensive coverage. This covers damage to your car from things that aren't collisions. Think theft, vandalism, hail, fire, hitting a deer. Again, usually optional unless you have a loan. Number 4, personal injury protection, or PIP, and medical payments coverage. These pay for medical expenses for you and your passengers, regardless of who caused the accident. In some states, PIP is required. In others, it's optional. The difference? PIP often covers more, like lost wages, while medical payments coverage is simpler and cheaper. Okay, those are the basics. Now let's talk about where people waste money. Mistake number 1, choosing a deductible that's too low. Your deductible is the amount you pay out of pocket before insurance kicks in. Let's say you have a $500 deductible. You crash. Repairs cost $3,000. You pay $500, insurance pays $2,500. Now, here's the trap. Many people choose a low deductible, like $250, because it feels safer. But here's the math. Lowering your deductible from $1,000 to $250 might increase your premium by $300 per year. If you never file a claim, you're just throwing away that money. The smart move? Choose the highest deductible you can comfortably afford to pay in an emergency. For most people, that's between $500 and $1,000. You'll save hundreds every year. Mistake number 2, not comparing quotes from different insurers. Here's the reality, insurance companies use hundreds of factors to calculate your rate. Your age. Your zip code. Your credit score. Even your job title. And every company weighs these factors differently. So one company might give you a great rate, while another charges way more, for the exact same coverage. Example, a 30-year-old teacher in Chicago might get quoted $1,500 from Company A, but $2,200 from Company B, same coverage. $700 difference. The fix? Compare at least 3 to 5 quotes every year. Use online comparison tools. It takes 20 minutes and could save you hundreds. Mistake number 3, keeping full coverage on an old car. Let's say your car is worth $3,000. You're paying $800 a year for collision and comprehensive coverage, with a $500 deductible. Think about it, if you crash, the most you'll get is $2,500, the car's value minus your deductible. So you're paying nearly a third of your car's value every year just to insure it. The rule of thumb? If your car is worth less than 10 times your annual premium for collision and comprehensive, drop those coverages. Just keep liability. You'll self-insure the car and save that money for a replacement when the time comes. Okay, now let's put this into action. Here's a simple 7-point checklist you can use right now to review your current car insurance policy. Grab your policy, or log into your insurer's app, and go through these one by one. Check number 1, are your liability limits above the legal minimum? Most states require something like 25/50/25. That's $25,000 per person for injuries, $50,000 total per accident, and $25,000 for property damage. But here's the problem, if you cause a serious accident, that's nowhere near enough. You could get sued for the difference. Experts recommend at least $100, $300, $100. And the good news? Increasing your liability limits is usually cheap, maybe $10 to $20 more per month. Check number 2, can you afford to raise your deductible? As we discussed, a higher deductible lowers your premium. Pull up your emergency fund balance. If you have at least $1,000 saved, consider raising your collision and comprehensive deductibles to $1,000. You'll likely save $200 to $400 per year. Check number 3, are you paying for coverage you don't need? Look for extras like rental car reimbursement or roadside assistance. If you already have these through a credit card, AAA, or another membership, you're paying twice. Also, check for gap insurance. If your car isn't financed or leased, you don't need it. Check number 4, are you getting all available discounts? Insurers offer dozens of discounts. Multi-car, multi-policy, good student, low mileage, defensive driving course, safe driver. Call your insurer and ask, what discounts am I missing? You might save 10 to 20% just by asking. Check number 5, does it still make sense to insure an older car fully? We covered this earlier. If your car's value is low, dropping collision and comprehensive can save you hundreds. Check your car's current market value on Kelley Blue Book or Edmunds. Then do the math. Check number 6, when did you last compare quotes? Insurance rates change constantly. Your insurer might have raised your premium without you noticing. Set a calendar reminder once a year to get new quotes. Even if you don't switch, you'll know you're getting a fair price. Check number 7, review your policy every time something major changes. Got married? Had a kid? Moved? Changed jobs? Bought a new car? All of these can affect your rate, sometimes for the better. Update your insurer so you don't miss out on discounts or end up underinsured. Alright, let's wrap this up. Now you know what each type of coverage actually means. You know the 3 biggest mistakes people make: low deductibles, not comparing quotes, and overinsuring old cars. And you have a 7-point checklist to review your policy right now. Here's my challenge for you: pause this video, grab your policy, and spend 10 minutes going through that checklist. I promise you'll find at least one way to save money. If this video helped you, give it a thumbs up and subscribe for more breakdowns like this. Drop a comment if you have questions, I read them all. And coming up next, we're diving into home insurance. I'll show you how one small clause in your policy can save you thousands if disaster strikes. You won't want to miss it.